You are listening to Keystone's Stock Talk Podcast, episode 81. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, in our Your Stock Our Take segment, we answer a listener's question on Metalla Royalty and Streaming Limited, symbol MTA on the TSX Venture, a precious metals royalty and streaming company which engages in the acquisition and management of precious metal royalties, streams, and related production-based interests in Canada and Australia. With gold prices higher on the year and Metalla essentially a pure-play gold and silver streaming company and royalty company with a small dividend yield, a listener asks us our take on the stock. Our dog of the week is Avicanna Inc., symbol AVCN on the TSX, which focuses on the research and development, cultivation, manufacture, and commercialization of plant-derived cannabinoid-based products and extracts. Avicanna shares have been in a free fall since listing on the Toronto Stock Exchange in mid-July, dropping roughly 65%. In the last 2 weeks alone, the stock is down over 45%. Is the drop an opportunity or a cautionary tale? We will discuss. So let's get into the show this week. Aaron, you're fresh off an appearance on Canada's most listened to financial radio program, Money Talks with Michael Campbell.
Money Talks,
how'd
yes.
it go?
Oh, it always goes well. I always enjoy my conversations with Michael. You know, we talked a little bit about investing for income in a low interest rate environment, and of course, I went into Keystone strategy about mixing different types of stocks and how to do that. Dividend growth stocks, small cap, high growth, small caps. How to get some geographic diversification in your portfolio. And we talked about a couple interesting companies too. So people can, I believe, go to our social media and take a look at the
full interview there. Yeah.
The full interview there.
And I think we're going to include maybe one of the stocks you talk about, tag that onto this podcast potentially, and one of the stocks, just get your take on one of the stocks that you talked about on air there. Maybe Brookfield will tag that into this this podcast as well as a little bonus. And you also...
Sure, did you want me to talk about that a little bit?
I think we could just take the clip off of there and put it in here. I think we'll do that for the listeners.
Certainly.
So that
that makes sense.
They can hear you pontificate about Brookfield, which will be good. One of our long-term winners in our portfolio, and a company we continue to like over the long term. A great example of a great dividend-paying company that's growing that dividend over time. They can hear you talk about that from the Money Talk show. You also talked about our DIY upcoming seminars, which is a good segue because we'll do a quick chat about that now. We're coming up this fall. We'll be in Ontario in 3 cities coming up, not this week, but next week. So it's coming up quite soon. Some of the highlights of this seminar, we call it the new way to build your portfolio. You're going to learn why traditional big bank, high fee model, the model there is killing your returns. Building essentially investors' overly complex, high fee portfolios composed of too many funds and too many stocks. Our simple solution to that problem is we help you build a 10 to 25 stock portfolio focused on quality dividend growth stocks as your core holding, and you supplement those by quality growth stocks. Now, you're going to get some macro outlook there. You're going to find out if the stock markets are cheap or expensive currently and what to do if there is a recession or crash. One of the great things about this seminar is you're going to get a 5-stock starter portfolio, so 1 or 2 of the best dividend growth stocks in Canada, 1 or 2 of the best unknown but highly profitable Canadian small caps, and 1 or 2 of the best U.S. growth stocks will be included as a little teaser starter portfolio for all the attendees who come to that seminar. Last year at this time, I think you did the numbers on the 5 stocks we included, or 5 or 6 stocks we included last year. Do you have those numbers on what the performance was on average there, Aaron?
On average, yes, it was as of Friday, it was 34.3%.
Yeah, I mean, and
that was six companies, and that included some big winners like XBEL, like Viamed,
Questor, I believe.
Questor as well. Yeah, some big winners, and of course, our clients had the opportunity to buy at prices well below that as well.
Which is important to point out, yeah. And I think one of the other things we provided that starter portfolio, which performed tremendously well. But we also, we went into research about some of the hot themes at the time: cannabis, blockchain, big data, cybersecurity. Made a recommendation in cybersecurity. We did all the work on the cannabis sector this time last year ahead of legalization to get a book on all, at that time, 120 companies in this segment. Couldn't find a single company that matched our criteria. We'd love to have found a growth at a reasonable price company in that arena. Couldn't find it, so our conclusion was to avoid that segment. And you can look at the sector's been decimated over the past year. If you look at where the cannabis stocks traded this time last year, where they are trading now, just tremendous losses, a huge destruction of capital, and a cautionary tale too. At the time, we said avoid hot theme segments like this, and it was the right call. And you see that portfolio that we recommended up over 33, 34%, Aaron said. And the TSX over that period is up around 3.5%, 4%. So crushing the TSX, looking outside of the hot themes of the day, buying good solid cash businesses. That's what you're going to hear at our upcoming seminars. I think it's an important lesson in any type of market. Just really to simplify your portfolio, you're going to pay some less fees by using us as an advisor and taking control of your financial future, building that portfolio that enriches you, not your advisor. So get your tickets. They're going fast, and would love to see all of our listeners there at these segments or at these seminars.
It's interesting. Just as a bit of an aside, some of to highlight some of the things that we're going to talk about at the DIY. I recently had a client approach me asking me to take a look at a bond ETF. It was a conservative bond ETF run by one of the big banks. And so I did some research on this for him. Yeah. And what I discovered was, it was really kind of, I'd like to say interesting, but it was somewhat disappointing the way this ETF was structured. You essentially had a situation where this was an ETF that was charging a management fee, and then it was buying other ETFs, largely from that same bank, which themselves charged management fees. So you were stacking management fees on top of themselves. And this particular bond ETF was charging a management fee of 1.6%, which I think is absolutely huge.
That's when all you're doing, in my opinion, but yeah.
All you're doing is buying other ETFs, maybe 10 to 20 other ETFs, right? But you're looking at something that, is going to return mid-single digits, and it's charging 1.6% fee. This is the type of thing that you need to avoid. Now, there are ETFs out there that are structured in a much more beneficial way for investors, and that's something that we would direct somebody to if they wanted to not own individual stocks, or if they wanted to put a portion of their portfolio into an index fund. But, this is one of the things that we're going to talk about. It's just how the traditional financial model is not working for investors, and you literally have situations where you're stacking fees on top of fees. Your financial advisor can charge a fee to put you in funds that charge a fee. Sometimes those funds buy other funds that charge a fee, or invest in other managers that charge a fee, and you just don't know how deep the rabbit hole goes.
Yeah, and again,
you stack all those fees. It eats into your return.
Yeah, and that's the key. It's eating into your returns over time, and try to pay as little fees as you can as possible, and get really good advice that is independent. And that's what we're trying to provide at these events. Whether it be your bond ETF or equity ETF, we'll have some advice on that as well. So week 1 will be in Oakville on October 8th, in Markham on October 9th. October 10th will be in Kitchener-Waterloo. Week 2, October 15th, Kamloops. October 16th, Victoria. October 17th, Langley. Week 3, October 22nd in Vancouver. October 23rd in Calgary. And we'll end off October 24th in Edmonton. Now let's get into the show. Now that we've gone through all of our DIY materials, we're going to get into Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We got a question from a listener on Metalla Royalty and Streaming Limited, MTA, on the TSX Venture. Aaron, you want to take that?
Certainly. So Metalla Royalty and Streaming trading right now at a price of about 130, 140, a market capitalization of about $180 million. Metalla Royalty and Streaming is a pure play gold and silver streaming and royalty company. The company's business is to invest in a portfolio of precious metals projects from which it generates royalty and streaming revenues. Metalla is a younger company, and it's trying to emulate the business models of other more established precious metals royalty stocks like Franco-Nevada and Wheaton Precious Metals. Metalla's share price is up 68% since the start of the year. This is an impressive run, although most of the precious metals royalty companies have had a strong move up this year. A key driver behind this performance is undoubtedly the price of gold, which is up 23% over the past 12 months from $1,200 US per ounce to about $1,480 US today. The price of silver is also up about 19% over the last 12 months, sitting at just over $17 per ounce today. Looking at Metalla's financial results, their recent annual financials that were published for fiscal 2019, revenue was $7.9 million, which was a 7% increase over the previous year. Adjusted EBITDA was $2.1 million. Compared to $2.8 million last year, so down 26%. The company did report a net loss of $2.4 million compared to a loss of $2.6 million last year. And there was some positive operating cash flow, just under $2.3 million in operating cash flow compared to $2.8 last year, so a decline in cash flow. One of the things I noticed about this company is that it's very expensive. Relative to its EBITDA and its operating cash flow. So about $2.3 million in operating cash flow, $180 million market cap. It's a pretty heavy valuation. Enterprise value to EBITDA of about 83 times. So the valuation is quite up there, is quite high. Our take is that Metalla does not meet our investment criteria. The company is expensive relative to EBITDA and cash flow. Financial performance over the last year was not that impressive, with only 7% revenue growth, lower cash flow, and negative earnings. It appears to us that most of the company's strong share price performance in 2019 has been the result of higher precious metal prices. One of the issues that we have with commodity-sensitive businesses like metals and oil and gas is that so much of the company's success or lack thereof is driven by volatile commodity prices. This is great when the price is your friend and moving higher, but it gives companies very few options when prices are going down. Metalla has reported several royalty acquisitions over the past year. These may result in better growth for the company on a go-forward basis. That is something that investors can watch for. However, from what we can see today, the fundamentals are not strong enough for us to be interested in the company. We would potentially look to some of the more established precious metal streamers if we wanted to get into that space.
Yeah, no, I would agree, Aaron. Just, companies that are resource-driven, driven by the commodity prices, driven by the underlying commodity. Always we would have, if we considered a recommendation in this segment, it would always be a spec buy because management can do everything exactly right and the commodity can turn against them, and then the share price can get, can crater over the course of the near term or a year period. These businesses, streaming, companies like Franco-Nevada have outperformed using this model. But I think, part of it is quality of management there too as well. The track record with Metalla isn't there. I'm not saying it's a bad track record. It's just they haven't been around long enough to establish that track record. We'll continue to monitor the company, but like Aaron said, the valuations are a little high at this range. And if you see a pullback in the underlying commodities, the company could easily correct back to a range that it was in ahead of a move forward. Now, if you believe gold is moving higher, it may be a situation to look at. I have no specific knowledge in that area, and that is the issue. Many who say they do, we would say do not know where the price of gold is moving. It's very difficult to predict. So let's move on to our dog of the week. From our Stars and Dogs segment, it's time for this week's dog. We're going to start with Avicanna Inc., symbol AVCN on the TSX. Currently trades around $2.20, $49 million market cap. So the dog performance here. Now, the stock has been in free fall since it listed in mid-July, dropping 65%. In the last 2 weeks alone, the stock is down 45%. What does Avicanna do? It's headquartered in Toronto, focused on the development, commercialization, and manufacturing of plant-derived cannabinoid products. The bulk of Avicanna's research and development is being conducted at the Johnson & Johnson laboratories in Toronto, their science incubation center. The company is in the process of conducting clinical trials for its therapeutic Pura Elements brand and the manufacture of its Pura Earth cosmetic brand. It owns 60% interest in a subsidiary, Santa Marta Golden Hemp, one of the few fully licensed and registered cultivators in Colombia, giving it an advantage over its peers in the equatorial nation. Now, that operation, along with Avicanna's other 70% owned subsidiary that is located in Santa Marta, gives it 250,000 square feet of licensed cultivating area. This is expected to expand to 410,000 square feet, giving the company 2,000 kilograms of productive capacity projected monthly on completion of its Phase 1 project. It is anticipated that those outdoor cultivation facilities will have low-cost production expenses because of the many advantages offered in Colombia, including steady sunlight, as well as low-cost energy, water, and labor. That'll give Avicanna an advantage over many growers focused on indoor cultivation in Canada. Now, our take on this company, it is a very early stage company. It has minimal revenues at this stage. I think in the last quarter it was about $16,500. There was a net loss of $4.5 million in the last quarter, up from a loss of $1.5 million. The metrics, you can't do any fundamental valuation on this business. They are a development stage company and speculative investment at this stage. They have yet to produce a commercial cannabis crop or make any sales, underscoring the considerable risks surrounding their operations. Avicanna finished the last quarter with around $13 million in cash on hand, but like I said, the company lost $4.5 million. The company will likely require additional capital by year's end. This is not a good sign for existing shareholders in terms of dilution. Just 2 months ago, the company had a market cap of $155 million, far too rich for its underlying financial position. The market cap is now a third of this, but despite this drop, we see little current value. Its recent loss, though, give it the title of our Dog of the Week.
The sector overall, even amongst the largest companies in the Canadian cannabis space, has really taken a major hit over the past 6 months, and really over the past year as well. So I'd be very cautious about investing in or buying shares of one of the smaller companies, one of the emerging producers. There are companies out there that already have production, have already proven that they can grow and sell at a mass scale. That would be better options if somebody wanted to get into that space. But I think that if they have to raise money, that may be an issue because the companies have really taken a major haircut over the past 6 to 12 months.
Yeah, and I mean, we're looking through all companies, continue to monitor this sector. Avoided it this time last year with the losses that you've seen over the first 9-10 months of this year. You may see further losses into tax loss selling, people just washing their hands of this segment. Perhaps if we find some companies that have gone through a couple quarters or 1 or 2 more quarters and hit EBITDA profitability and hit growth, maybe we'll see some more reasonable valuations at that stage. We'd stick to the leaders in this sector if you're going to stick anywhere, but we haven't found value and growth at a reasonable price. And until we find that, we're not buyers in this segment. And I'm not surprised by the losses that you've seen over the past year in this segment. Okay, well, I'm going to thank all our listeners for listening again this week. I thank Aaron for co-hosting, and keep your questions coming into our Your Stock, Our Take segment. We'll keep endeavoring to answer those questions over the course of the next few weeks. Again, come out to one of our DIY seminars. Love to see you all there. I wish you all profitable investing.
Profitable investing.
As a bonus to our podcast listeners, and for your convenience, we are going to insert a clip of Aaron's most recent interview with Michael Campbell on Money Talks Radio, where he is discussing one of the stocks that we have re-recommended the most, Brookfield Infrastructure, ticker symbol BIP.UN on the Toronto Stock Exchange. Enjoy.
Just on the topic of a very solid dividend growth stock, I'm going to talk about a company that's been a long-standing recommendation in our research. That's Brookfield Infrastructure. The symbol is BIP.UN on the TSX, BIP on the New York Stock Exchange. I've talked about it on your show many, many times. So Brookfield, this is a global infrastructure company, very solid conservative stock, but also a growth company as well. So they own infrastructure projects all over the world, and these are long life, stable projects that generate stable cash flow. So you look at a company like this, it's growing, but its current cash flow is also very well positioned for a recessionary environment. We originally recommended the company in 2011 at $14.50 per unit. Today it trades at $66 per unit. So great return in terms of capital appreciation based on the financial performance. But what really impresses me is that they have paid out about $12 US in income distributions to their investors over this 8-year period. So that's $12 US. We recommended them at $14.50 Canadian. You basically have your money back on a pre-tax basis and a company that's continuing to grow. I know you always ask, well, it's done great in the past, so why are you still recommending it in the future? Well, they are continuing to grow. So the recent financial performance has been strong, low double-digit growth in cash flow per unit. They have an investment backlog of about $2.2 billion US that they are commissioning over the next 3 years. So we're expecting 2020 to actually be an excellent year of growth. And this is a company that just continues to produce. It pays a very nice yield of about 4%. It's growing that yield every year. The unit price has been appreciating. We believe that the income distribution is very sustainable. The growth is sustainable. And even though it's come up a lot over the past 8 years, we still think relative to the quality that it's trading at a reasonable price. Now, this isn't a company that I want people to go out and buy because they want to get a big return in the next 6 months. That may happen. It's had a great year in 2019, up about 40% so far. But we want people to look at a company like this as something that they want to own and generate income from for at least the next 3 to 5 years. And that's what we're recommending it for. So great long-standing recommendation, but we still think that it has a good solid future.